In this session, we will show you how to derive the pre-tax discount rate. IAS 36 requires the value in use to be a pre-tax calculation on the level of cash flows as well as the level of discount rate. However, in practice, it's not possible to determine a pre-tax discount rate, as the capital market data that goes into your typical WACC calculation is on an after-tax basis. So when you calculate WACC or any discount rate, you would obtain beta, obtain the capital structure data of your comparable companies. All of this information is already influenced by tax. So your typical WACC and discount rate is automatically a post-tax calculation. It's automatically a post-tax WACC and a post-tax discount rate. However, IAS 36 specifically requires a pre-tax discount rate. So how do we then adhere to the standards? The first step we do is to derive a post-tax discount rate and apply this to post-tax cash flows. So this is the typical DCF when determining business value. You pull your WACC, you get your free cash flows, you calculate your business value. Theoretically, the business value determined using post-tax discount rate and post-tax cash flows should result in the same value as when using a pre-tax discount rate and pre-tax cash flows. Therefore, in step 2, we take our post-tax cash flows and we adjust them to come to a pre-tax basis. And holding the business value determined in step 1 constant, we iterate the pre-tax discount rate. This is best illustrated through an example. In this example, I will illustrate how to derive the pre-tax discount rate from your post-tax calculations. In my example, I'm using a retail CGU in the US. The measurement date is 1 December 2019. As you can see, I have applied the US tax rate and US terminal growth rate. I am not going to go into detail on the DCF method and its assumptions in this session. That is covered in a separate session on business valuation. In this session, I am going to focus solely on the post-tax and pre-tax calculations. I have named this worksheet Step 1 Post-Tax Basis, and Step 1 is a typical business valuation using post-tax discount rate, which is a typical discount rate, also known as your WACC, and post-tax cash flows. So step 1 says discount post-tax cash flows using a post-tax discount rate, which was derived using observable market data. So this is your post-tax basis. Again, this is your typical business valuation, where you have your typical free cash flows and your standard discount rate, which is also known as your WACC. Step 1.1, use a post-tax discount rate, which is derived using market data, which is your WACC. As mentioned before, market data is always influenced by taxes. So when you're deriving a WACC, it's not possible to derive a pre-tax discount rate. When you derive a WACC using market data, it's automatically a post-tax WACC or a post-tax discount rate. So now that we've settled that, your discount rate, which is your typical discount rate, is automatically a post-tax discount rate, so you don't have to do anything special for that. Step 1.2 says ensure post-tax cash flows. What is post-tax cash flows? All this is saying is ensure your cash flows include your tax expenses. It includes any potential tax items in net working capital. And what I have here is a post-tax cash flow done for you. So your tax expenses has already been included in the calculation. It's already been taken into account. This is a post-tax free cash flow. This is your typical free cash flow. So we have a post-tax discount rate and we have our post-tax free cash flows. Step 1.3 says derive the VIU by discounting post-tax cash flows at the post-tax discount rate. And I've done my discounting and I have come up with my VIU of around 1.8 million, 1.9 million. Now we move on to step 2, which is to determine the implicit pre-tax discount rate that needs to be applied to pre-tax cash flows to arrive at the same result which was obtained in step 1. I'm going to explain it to you step by step, which will make it much more easier. Step 2.1, create a copy of the post-tax basis worksheet and rename it Iterate Pre-Tax. I've already done that here for you. As you can see, the calculations here are the same as here. So I've taken my post-tax calculation and I've copied it onto a new worksheet. However, since this is a pre-tax basis, step 2.1 goes on to say, ensure pre-tax cash flows. What is pre-tax cash flows? This means we want to remove tax expenses and any potential tax items in working capital completely out of our cash flow. The way we do this is we can just eliminate anything related to taxes from this free cash flow. So I've just removed taxes. This becomes earnings before interest and tax. And if I had any tax payables or any tax related items in my working capital, I would also basically remove them. In my example, which is very simple, I don't have any tax items in working capital. As you can see, my value in use, my VIU, has gone up because this is a pre-tax cash flow. It hasn't deducted the taxes, which means the cash flows are actually more, which has given me a higher value in use. Theoretically, the results from a pre-tax calculation should be the same as a post-tax calculation. So if I update my summary results here, I have a pre-tax cash flow and my VIU is now 2.1 million. How do we resolve this difference? And that brings us to the last step, which is to iterate the discount rate. This means what discount rate percentage will result in the same VIU as my step 1, as my post-tax basis. If I lower my discount rate by 1%, my value in use goes up and doesn't solve my problem. So if I increase my discount rate, okay, I have managed to bridge the gap. Now, this can take hours to try and figure out the exact discount rate to give me the same result as step 1. But there's a trick in Excel that we can use to find the discount rate that will result in the VIU being the same as step 1. And the trick is called goal seek. Make sure your cursor is on the VIU calculation. Go up to your ribbon, data, what if analysis, goal seek. And we want to set this value to the result in step 1, which is 1881095. By changing our discount rate, remember we want to know which discount rate percentage will give us the same result as step 1. Let's update that. And voila, the answer is 12.5%. There you have it. 12.5% is the pre-tax discount rate for the retail CGU in the US. As you can see, when we have our post-tax cash flow with a post-tax discount rate, it gives us 1.88 million, and our pre-tax cash flow with a pre-tax discount rate gives us the same result. And this is the number that you would need to be in compliance with IAS 36, impairment of assets.